Okay, I see a few more folks joined in, so let's not waste anyone's time. Okay, first thing, thank you for joining. It's a Saturday morning for me, Saturday evening for y'all. And just to introduce myself, my name is Sham Chulani, and by profession, I am an IT professional. Some of you might be knowing me, and I have over 30 years of experience in the investing field. And along with my partner, Mr. Sheel Gupta, who's a very successful businessman, we also have a franchisee in Pune for by the name of Investment Ventures, and we are franchisees of Kotak Securities. So that's just a little bit of introduction about myself. And stock markets has been my passion, so that's the reason I thought of now trying to share whatever knowledge I have, because uh, over the years I have learned a lot in this field. I mean, till date you can continue, you can learn till you die in this field. So there is nothing that you have achieved everything in this field as of now or even going forward. So I keep learning, and I wanted to share my experiences, and that's the reason I thought of coming up with this YouTube channel and also with these classes. So let me start with the presentation. I'm just going to check if it's visible. Okay. So as a disclaimer, now this video is made only for educational purpose, and even if we refer to any stocks, there is no intention for you to go and buy and sell without consultation of your financial advisor. Okay, and if you've been following us on YouTube or on Telegram, do subscribe to our YouTube channel. Follow us on Telegram, where we provide you live updates even during market hours, as well as it's an easier form of communication. But if you want to look at our videos, if you want to see those investment ideas, if you want to see those educational videos, then subscribe to our YouTube channel. Okay, so we will do this trainings in three parts. What I wanted to cover today is the options basics, because I know many of you are investors in the market. Many of you probably have been doing this for a long time, but options has always been very confusing for many people, and I do have people reaching out to me asking about options. What is a call? What is a put? Is this trade okay? Does it make sense to do this trade? What is the risk? So it's a very risky instrument, but if you use it well, it can be very powerful. That's the reason I thought I'll start with the basics first. And then we do plan to have another session on advanced options, where you can see a lot of the strategies that we use, and you can use it to make a lot of money, but you have to use it very wisely and at the right time. So if you think about options, it's actually very simple, but it's only the experience in options that's what you need to gain, because that nobody can teach you theoretically. You will only learn by experience, and only then will you really understand the power of options as well as how it can go against you. I mean, I can definitely guide you, and even if you reach out to me separately on Telegram, WhatsApp, just to check about a trade, if you want to do whether this is right, wrong, what is the payoff, what is the risk, I am happy to help. But this will truly come with experience. And lastly, I thought I will still do one more on the basics of stock market investments. Now, this is mostly based on my personal preference, because I do have a young student in my house who's going to college, and he's taken up finance, and he was interested in stock market investments as well as his friends were. So they keep asking me, when can you teach us? So I thought, okay, I'll use it as my as something that I can do on my YouTube channel. And then most recently, I don't know how many of you would be familiar with the GMC as the AM, the GME, the GameStop, as well as the AMC share price hike that happened in the US, where stocks went up from 20 to $400. And then my young son, my youngest son, he's in high school. He came up to me and he said he wants to start investing in stocks because his friends were. So that's the reason I thought I will just kill their curiosity and teach them something so that they don't fall into this trap and don't end up burning money like I have over the years. And then only I started learning and using it wisely to my advantage. Okay, so what are futures and options? Before that, let me see if I need to address any comment. Okay, so what are futures and options? Futures and options are basically derivatives, which means that they do not derive their price on their own. They derive their price out of an asset. So it is something that tracks the price of an asset. Okay, so they do not have a price on its own. Like for example, the Nifty has a price on its own. Gold has a price on its own because they are assets. Nifty is an index, of course. Gold is an asset. Silver is an asset. A stock could be an asset. Any contracts that derive the price of an asset are basically derivatives. And when I say futures, futures are forward contracts that can be traded on an exchange and settled on exercise dates. So every future has an exercise date. It could be a series, it could be a monthly series, it could be a weekly series, it could be a quarterly or a yearly series. So they have an exercise date and they are traded on the exchange. Now, before futures came, there is still something which is called as forward contracts. Now, forward contracts are typically not traded on the exchange and are done between two parties. So there's no guarantor in a way. For example, in an import and export business, you might have two parties doing a forward contract on the exchange rate. So that's forwards. Futures is something that can be traded even before its exercise date. So it can be traded on the exchange. There's a guarantor, the stock exchange regulator guarantees that price to you or guarantees that transaction to you. And unlike forward, where there's no guarantee, it's just between two parties. And then options is so the buyer of there are two parties to an options contract. One is a buyer and one is a seller. Now, if you want to go long on something, then you use call options. And if you want to go short on something or if you want to sell something, you can use a put options. So basically a buyer of an options, whether it's a call or a put, has the right but not the obligation to buy or sell the underlying asset at the transacted price or the deal price, like they call it, the strike price. Okay, and he can do this before the exercise date or on exercise date. Now they work separately here, but I'll explain to you what all goes into the exercise date, what is the volatility premium, all those things that are considered and go into options pricing. Okay, I just put this in here for also letting you all know the dangers of using options, because it's not something that I want anybody to just go out there and start using just because you think it is attractive, because it's fancy, or because you think you can make tons of money. No, it's not like that. You can also lose a lot of money in this. So you need to be very careful. And only if your portfolio is of a sufficiently large size, then I would recommend using options. Otherwise, I would say stay out of it. And even in 2002, Warren Buffett had made a statement that derivatives are financial weapons of mass destruction. So basically, if you don't use it right, you will definitely lose money. So you need to be very careful while using options. But it is, like I said, it is very powerful. And he himself, as Warren Buffett has also said, that he himself engages in using futures and options and derivatives, but for certain investment strategies. And in the following slides, I will show you what these basic strategies are. and of course in the advanced one we'll see them how we can really use them to our benefit. Okay, so when do you trade options? Okay, I'm just gonna check there on the comments if there's anything. Okay, when do I trade options? First thing is, if you don't understand options, never, don't ever trade options without really understanding them, because for sure you will lose money. They seem very simple. A buyer of a call has the right to buy a stock. You invest less money, you can make more money. But no, do not trade options if you don't understand how the price moves, how time decay happens, what is the instinctive value of that option. So unless you understand that, don't trade it. Repeating this, if you don't understand options and you don't understand options well, please do not trade it. You are sure to lose money to the operators who are using them to the advantage. You can use it to hedge your portfolios if you have a sufficiently large portfolio size and you want to hedge your positions. You want to hedge the risk that is coming out of certain events. Could be a earnings event, could be a budget session, or could be some political thing happening in the country. You might use it to hedge your portfolios. You can also use it to make extra income on idle stock that's lying in your account. Only if the stock is also traded in the futures and options category, because many B group stocks, C group stocks will not be trading in options, but A group stocks do trade in options. If I'm talking about the US, Apple, Facebook, these kind of companies would trade in options. If I talk about India, it's Reliance, Tata Steel, and then Asian Paints, the big ones, Indian Oil. These stocks would trade in options. Even the Nifty, Bank Nifty. You can also use sophisticated trading techniques to enhance your return or multiply your return manyfold once you have learned these strategies. But it does come with a caveat. You need to use it, you need to understand it really well. You need to understand how time decay works, you need to understand how volatility works, and only then can you use these sophisticated trading techniques. There is a payoff in that. There's a small risk, there's a return. Whatever the way you calculate and the way you position it, that's the way you can look at your payoff. So you can end up making big returns and you can end up losing big or losing small, depending upon how you have used your position. So you can have multiple positions to make a strategy. That we will see in the advanced option strategies. And you can use this particularly during events. So if there's a results season, or if there's elections, there's budget coming up, and you are unsure of how the markets will play, or you have a direction in which you feel the market is going to trend based on the election results or based on the results of the stock or the budget, then you can make a play also in options for that. Okay. And last thing, please do not overtrade options, because I am repeating this every time. It is a risky instrument unless you know it well and you use it to your advantage. Okay, so few things that you need to understand before you get into trading options. There are different types of options. One is an American option, and then there is European style of options. So this is the style of options. Now, American options can be exercised at any point of time before the expiry date, and European options can only be exercised on the expiry date. So that's the major difference between American and European. Usually, when it comes to options on the index, then it is always European, because you never call for an exercise on an index. You usually call for an exercise on a stock. But in European options, whether it's a stock, whether it's an index, it is always exercised only at on exercise date. Then there other type is of course a call and a put. A call is something when you want to go long on a stock, so you buy a call. If you want to go short on it, you can sell a call, but that's risky again. There's a payoff, different payoff for that. And when you want to go short on a stock, you can buy a put, and if you want to go long on a stock, you can sell a put. So again, until you understand this well, don't try it. Then you need to know the direction of the trade. So if you want to play on the long side, you can buy a call or you can sell a put. And if you want to play on the short side, you can buy a put or you can sell a call. Every option has a strike price, which means your deal price at which you're making that deal. So it could be, let's say, if the Nifty is trading at 15,000 today, and you do an option or a strike of 15,200, that's your strike price, or that's your deal price, like they call it. There's a premium that's involved in options. Now, it is a premium that you pay at the strike price. So typically it would be the largest when it is at the money, or probably in the money. Then it comes at the money, and then is out of the money. These are three terminologies. So which means that if Nifty is at 15,000 today and you are doing a strike of 14,800, that means you're trading an option which is in the money. If you are doing a strike of 15,000, it is an option at the money. And if you do something that is way out, 15,200, 15,300, that means it is an option which is out of the money. And the premium depends on the strike that you choose. Then there's instinctive value of an option. Now, instinctive value means how much is the call or the put in the money. So if the Nifty is at 15,000, or a stock is, let's say, at 100, and you are doing an option which is of strike 90, which means the instinctive value of that option is 10 rupees or $10, because it is already in the money. Now if you were paying an premium of 15 on a strike of 90 when the current market price is 100, it means that the instinctive value is 10 and the time value is 5, because 10, the current market price minus the strike price, is what your instinctive value is, and the balance is time value. So your time value considers the time that is left for the option to expire. Now, if you do longer range options, the time value is obviously more, but if you do shorter range options, the time value is less. And there are ways and strategies that when you should use what. Particularly if you're a buyer, it should be that you should consider long range options. And if you're a seller, then shorter range options make more sense. But again, depends upon what your underlying portfolio and what your underlying position is. So you might have a different play. You can use either or, but typically if you were a seller, then you would sell short range. If you were a buyer, you would buy long range, unless there's an event. So if there's an event, there's a budget, or probably a results that's coming due tomorrow, and you have an option which is expiring 2 days later, you can consider it because you're just playing for the event risk. Then you don't need long range options for that. Then we have series of options. So there are weekly series, there is monthly series, there's quarterly series, and there is also yearly series. So you can also have leaps in that case, which is long range expiration options. And the other thing that really people sometimes don't understand is the VIX plays a big role in the calculation of options, because higher the event risk, the higher is the cost of the options. and the time decay that it brings along with it is what people don't understand, and they think, okay, if I just buy a call, uh, either my once the stock goes up I will make money on it. No, it's not like that. Only if the VIX is high, only if the call moves up in a certain time frame, only if it moves up before the expiry date, only then you make money. Otherwise, even if you are a buyer of a call and the direction of the trend is in your favor, it goes up, you can still end up losing money if the VIX collapses. So this is the major thing that will come only by experience or if somebody really guides you. But VIX is a major player in options calculation. A terminology I did explain earlier, that is ATM is at the money, OTM is out of the money, and ITM is in the money. So you will see this whenever you're trading options. You might see this in your portfolio, you might see this in your brokerage account. So this is just to help you understand what it really means. uh, I've put up some examples here, and I also, at the end of this session, what I will do is I will also share an Excel sheet that I have, which I use for calculating and looking at my positions and what the payoff will be at expiry. So I can share that with you all. I mean, uh, originally it was a 5 level sheet, then I enhanced it to 10 levels, and then I went further and enhanced it to 15 level sheet. So once you key in your positions in there, you can actually see what the payoff will be at the end of the expiry period. So do share your email IDs with me and I will send that across to you all. So you can use it to just look at your positions and put in the positions to decide whether you want to increase another level of option in there or no. So it is very it is very helpful. I mean, I have used it many a times. Now of course it I can do the calculations just by looking at the various strikes, but previously I have used it to understand my exact position. And I, even if now if there are multiple positions that I have open, then I do go back and use that Excel sheet. So this is an example of a call options. Now, assuming the Nifty's current market price is at 15,080, and you're doing a strike of 15,000, the premium is 408. The expiry is on the 25th of March. Now, if you see, the instinctive value is 80 in this case because the current market price is higher than the strike. So you have 80, which is already in the money, and then the balance is your time value. Okay. You also need to look at the lot size, because lot size is where you will know what is your total contract value. Just don't go by the premium thinking that, oh, I'm just going to pay 408 rupees when the Nifty is 15,000. You're going to pay 408 into 75, which is close to 30,000 rupees. So you're going to pay 30,000 on buying this call for an expiry of 25th March. If you had done this, let's say, about a week ago. So if you had a month, you're going to pay 30,000 for this call option premium. Okay. Now you need to realize that on expiry date, if the Nifty is below the strike price, your call option is basically worthless. So you will end up with zero. You will end up losing your entire 30,000. Okay. And if it is above the strike price, you will gain whatever is the difference. So not necessarily you will gain if the strike is above 15,000, because your call is going to lose the time value and you will only make the instinctive value of that call. So let's say if it expires as on 25th March at 15,080, you will only get 80 bucks out of your 408. So you will still be a loser. Even if this ends up at 15,300, okay, the call has gone in the direction you took the trade, you will still be a loser, because you will only get back 300 from the market, whereas you have paid 408. If the Even before expiry, let's say 5 days before expiry, if the Nifty is trading at 15,200 or 15,300 and the VIX is really low, you might see the call premium at 340 and 350, which means you will still be a loser although the expiry date is not come. So that's where you really need to be careful, that unless unless you're familiar with how the VIX trades and how the VIX is going to behave, you can be a loser even if your direction of trade is correct. So see the various things that go into an option pricing. It's the instinctive value, which is you need to look at your spot price, you need to look at your strike price. In terms of time value, you need to look at the time to maturity. So it is different option maturities will behave differently when there's a moment in the price. If a near term option can expire quickly and will expire worthless quickly, but a long range option, if the direction of the trade is even wrong, can continue to increase in price if the VIX keeps on increasing. So that's what you will that's what you will understand only with experience, and that's the reason I say, if you have a doubt, feel free to reach out, feel free to ask before you take a trade. I am happy to help, but don't trade options without really understanding how they work. And the last thing is, of course, the rate of interest also goes into the calculation of an option pricing. So that's the third parameter. Now, this is more or less constant. I mean, interest rates don't fluctuate on a daily basis. They will fluctuate, yes, when there's a Fed decision or an RBI decision that's happening. But that also goes into the calculation of VIX, of your option pricing. Okay, now I have that Excel sheet. Now I will share that with you. But this is how a payoff would look like. So, and this payoff is showing you the payoff at expiry. It's not showing you the payoff during the the term. So this premium will behave differently during, and this is a payoff at the end at the expiry on 25th March. If we had done this trade of 408 at 15,000 strike price. So you can see that my break even is somewhere close to 15,408, which is a premium that I paid over 15,000. Now anything above that, if Nifty closes at 16,000, you will make 16,000 minus 15,408, which is like 592. And anything below that, you will lose money. So if it closes at 15,300, you will lose 108. If it closes at 15,000, you will lose 408. And anything below that, whether it becomes 14,000 or 13,000, you will not lose more than 408. So you will only lose the premium, but you cannot lose more than the premium. On the gain side, it is unlimited, but then of course you need to think whether it's going to move in that direction and it's going to move fast while before your expiry or at expiry. Similarly, I have put an example of a put option. Now, just there is small change in the calculation of the put option. So, if you do a put of, let's say, strike 15,000 again, now this put is out of the money because the Nifty is at 15,080. Now, if you see, the premium here is 303, whereas the premium you paid for the call was 408 because there's an instinctive value of that call that goes into it. In this case, since the put option is out of the money, there is no instinctive value in it. So it's an out of the money put option. The expiry is 25th March. The instinctive value is 0. The lot size is 75. So you will pay close to about 22, 23,000 for this when you do a trade, versus when you do a call trade, you would have paid 30,000. In this case, you're paying 22,000. Now, value of a put at expiry. Now, if the Nifty is above the put strike price, your value of the put will become 0. Okay. Value of your call will be whatever is the instinctive value, but your put will become 0. Now, in case if the Nifty falls below 15,000, your value of your put is the strike price minus the current price. In the call option, it was current market price minus strike price. In this case, it is strike price minus current market price. Okay, so let's say if your strike was 15,000 and your Nifty is ending at 14,000, you will make 1,000 minus the premium that you have paid. So you will make 1,000, which will become your instinctive value of your put. But since you have paid a premium of 303, you will make 697. Okay, but if it closes, let's say, at 14,800, you still end up as a loser because you will lose 103. 303 is the premium you paid versus what you will gain is 200. So you will still end up being a loser, although the direction of trade was in your favor. So this is a payoff again for a put option at expiry. Now, if you see my break even for the 303 premium that I paid is 407, 14,700, around 14,700, which is actually 14,693 if I paid 307 points for my put option. And then if the Nifty goes above 15,000, I will lose that 307 or 303, whatever I paid. I cannot lose more than that. That's why if you see my payoff is in a loss throughout. But if it keeps falling, then my payoff will keep on increasing in the put option, and the payoff is unlimited. So let's say if the Nifty closes at 10,000, you will make 4,000 minus 303, the premium that you paid. But don't expect these kind of moments unless there's an event or unless there's something like COVID that happened. Otherwise, Nifty or any stock will not. Stocks, yes, stocks can move 40-50% on their earnings day, but not the index. So if you're trading for big moves, then you will have to trade stocks. But if you're trading for income strategies and small moves or portfolio hedging, then you can trade the indexes. Okay, this I have just put in just to show you. Let's say if I were to do a call and a put together, right? I buy a call as well as I buy a put, and this is I would do this on an event. If it's an earnings event, if it's a budget session, then I can do this. Of course, the premiums and all at that point of time are really high, so you need to calculate if the move will be powerful enough to shake that up. Because if you're going to pay premiums of 10% on or 5% on the call and 5% on the put in an index, then you need a 10% move for a payoff to happen. Otherwise, you will end up in this V shape here where you will be a loser. Let's say the index doesn't move, you end up losing all your money if it moves in one direction, but the move is not powerful enough to cover up for the loss on the put as well as the premium you paid on the call. You will still end up being a loser. Only if the move is really powerful, that's when you will make some money. Okay. Now the risk is limited, but the premium you're paying is really high. So think about it, calculate it, think about how much the move is going to happen, and only do both this call and buying of a call and put. Okay. Now vice versa, if I was a seller, now if the VIX is really high and I'm playing on the index and I do have a portfolio that I'm using as a hedge, then I can consider selling a call and put, where of course the risk is unlimited, because if the move becomes very powerful, then I will end up losing money, either if it goes down or either if it goes up beyond that 10%. But if the move is not so powerful and the move is only 2-3% or even 5%, I will still be a winner. So depending on how sophisticated you have become in understanding options and the VIX, as well as how much they move during an event, or if you have been studying a stock, if you have been studying Reliance, or if you've been studying Facebook, or if you've been studying Google, or any other stock like Tata's, then once you understand the historical move during its earnings period and you have a fair idea on what it's going to report out, then you can use this even to sell options and make money. Okay, you can use it to sell options even if you're holding a stock and make that extra income, or you can use it just to hedge it, that okay, you're willing to get that 4-5% extra and let the additional profits go. So depending on that, you can use it. Okay, let me see, when do we lose entire money? What is a hedge? Okay, now let me answer these questions first. What is a hedge, and what when do we lose entire money? So hedge is particularly, let's say if you're holding stocks or if you're holding a portfolio. Okay, let's say you hold Reliance, or you hold Reliance plus Tata plus Asian Paints plus Marico, these all these stocks you hold, let's say 10 or 20 stocks, and your portfolio is worth uh, hypothetically, let's say 50 lakh rupees, right? Or $100,000. Either way, I'm looking at both geographies. So if you want to hedge your entire portfolio, if you have bought all these stocks and there's an event that's coming up, there's, let's say, a war that is anticipated, or a budget session that's anticipated not to go well, or there's an earning season that you don't want to risk on a Reliance stock or something, then you can use it to sell futures. Let's say if you're selling futures, you're using it to hedge your position. Now if you sell Nifty, for example, on the entire portfolio worth of 50 lakhs, now if the budget session went good, your stocks will move up. Let's say the budget session went good and your stocks moved up 10%, and the Nifty also went up similarly 10% or 7% or 8% or 12%. But you you will not make that money because you have lost money on the Nifty, but you have made money on the stocks. So your portfolio is hedged. And let's say it went against, the budget session didn't go right, and the portfolio goes down. I mean, market falls. Your stocks fall by about 10%, but you have hedged the portfolio by selling Nifty. So your Nifty also falls and it goes in your favor. So basically you have shorted the Nifty. And you make that 10% from the fall in the Nifty and cover back the loss that happened in the stock portfolio. So that's what I mean as a hedge. Irrespective of the move, you will not really make money or lose money. You will make money or lose money only to the delta percentage. Let's say if you have hedged it against Nifty and the Nifty moves down 8%, stocks fall 10%, you will lose 2%, but not the major 10%. Similarly, when it goes up also, if the stocks move 15% and the Nifty goes up only 10%, which happens many a times, you will make 5%. You will not lose, you will not make 15% in this case. You will make only 5% because you lost on the Nifty. And you can use even options to hedge your portfolio. You can buy, let's say, puts. You can buy puts on the Nifty, in which case, let's say on a 50 lakhs, you paid a premium of 1.5 or 2 lakh rupees. Now, if there was a big move in the Nifty which went up 10%, you will gain the 10%, but you will lose the 2 lakh premium that you paid on buying that puts. So you will lose 2-3%, but you will make the 6% move, or you will lose 4%, but you will make the 6% move. Versus if you had shorted the futures, you would lose the entire money on the Nifty once it went up. In this case, you will lose only the premium, but you will make the money on your share portfolio. Now, those are also strategies and payoffs that you can use for calculation. I can explain that to you during your advanced strategies session. Okay, and the next question is, when do you lose the entire money? So you will lose the entire money, let's say if when you're buying options, you will lose entire money when there's no move at all. The the Nifty or the stock that you have bought the call or the put in settles down at that rate or goes against the trade, right? So if you bought a call and the stock falls, your call is going to become zero at the end of at the expiry period. So you will end up losing your entire the money that you invested in the call. Or if you bought a put and the stock goes up or the index goes up, and you have bought a put thinking that it will go down, your put is going to become zero. Okay, so that's the time when you will lose your entire money, when your current market price is above or below your strike price, depending upon whether you have bought a call or whether you have bought a put. So that's the time you will lose your entire money. If it comes in the same direction of your trade but doesn't cover your premium, then you will still lose some money but not the entire money. I hope I've answered your question. Okay, so there are some other Greeks, also option Greeks, that you should be aware of. Now, This will come with experience. You really don't need to look into these terminologies and all these things. It will just come to you with experience as you look at options. Do paper trading if you like. Don't start trading on the market. And before you start trading on the market, I am happy to help you out. Just reach out to me. But few things that you should be aware of, because you will see this once you look at option calculators, what, and you will come across these terminologies. You'll see what is a delta. So delta is the sensitivity of change to options in the moment of price. So if the price is moving up, let's say price of Nifty moves up from 15,100 to 15,200. So that's a 100 point move. Now, will your option move from 408 to 508? No, because the option is not going to move just like the Nifty is going to move. Okay, even if you buy a stock, if you bought Reliance and it moves from 2000 to 2100, and you have bought an option, call option of 2000 strike for 100 rupees, your 100 rupees is not going to become 200. So that's what they say is the option delta. Your option will move from let's say, four in the case of Reliance, from 100 to 150, whereas the stock has moved from 2000 to 2100, right? So it's a 100 point move, but your option moved only 50. But if you see the payoff on return on investment, you invested 100 on the option and it has moved 50, which is a 50% return on investment. Whereas on Reliance, if you have invested in the stock for 2000, you're getting only 100, which is a 5% move. So the payoff is different in terms of return on investment, and so is the risk. Okay, theta is the measure of the time decay of an option. So if, let's say, you bought a call option on Reliance for 100 and it has got 20 trading days, and let's say every day goes by, typically you should consider it, okay, 100 divided by 20, the call option will start reducing by 5 on a daily basis. But that's not how it works. Theta is slow in the beginning period and really gains exponential speed towards the end. So theta is the time decay of an option, which is slow towards the when it is slow when you have more time remaining in the option, and exponentially increases speed when the option is towards its expiry period. Okay. Vega measures the sensitivity of a price to changes in the VIX. So, like I said, if the VIX is moving up or down, then your option will also move up or down, even if the stock price has not moved at all. So, let's say if you had bought Reliance yesterday and the VIX was at 30 and you paid a premium of 100 on Reliance. Today, the price of Reliance is, let's say, it has gone up by 2 or 3 rupees. So, you would have expected your option to go up. But if the VIX has fallen from 30 to 25, you'll be surprised to see that your option actually went down, although the Reliance stock went up. So that's what I keep repeating, that this you will gain by experience. You will have to look at the VIX. It is one of the major contributors to option pricing, and many people don't understand how this works, and they think that, oh, Reliance went up, why did my option go down? That's because you did not look at the VIX. The VIX has actually gone down because once in you enter stable territory, enter stable markets, VIX will collapse and it will go down. Or let's say vice versa. You have bought Reliance at 2000, you paid an option premium of 100. Now VIX was 25 yesterday when you bought it. Reliance actually went from 2000 to 1995, but because there's an event that's happening and there is uncertainty that's come up, VIX has shot up to 35. You will be surprised to see your call option go from 100 to 120. Although the stock of Reliance went down, went against you, but the VIX went up and so did your call option. So VIX is a major contributor. So until and unless you look at the VIX, do not buy or sell an option, because you need to understand how this VIX is going to play going forward, not only now but going forward. Okay, I'm happy to answer any further questions if we have. And what I want to show you is what we will do in our next session. I mean, I'm coming to the end of this session, but for the next session, what I thought for the advanced options, what we will cover: how do we use options as a hedge, whether we use futures, whether we use calls, whether we use puts, or whether we sell calls and puts. You can use either way as a hedge, and their payoffs are different. Some payoffs are limited, some payoffs are unlimited, some payoffs are risky, some payoffs are not so risky. Okay, as long as you're willing to sacrifice a little bit of profits. So we can look at these advanced strategies, do some paper trading, do some reading. I'm sure you will read and understand a lot more than what I have taught you, but uh, I can show you some strategies to use as a hedge. I can also show you some strategies that you can use to generate income. So instead of using keeping money in a fixed deposit, if you want to use to generate that additional 2-3%, if your fixed deposit is giving you 6%, 7%, I can show you some income strategies, absolutely risk free, provided you do it correctly. You can make, instead of 6-7% in the fixed deposit, you can make probably 10% through this route. The additional benefit you will get here is the tax benefit, because in your fixed deposit instruments you have to pay a tax, whereas in your equity instruments there's a difference in the tax structure, right? So you can use it to your advantage. You can also use it to offset some tax gains, right? So there are income strategies that you can use. If you're a businessman, yes, you can use it further, and you can probably, instead of making 9-10%, you can make between 13 to 14% also using these strategies through multiple accounts. So I can teach you that also. Then there are money multiplier strategies, where you can use a combination of these option strategies, calls, puts, and you can use it to make additional gains. Of course, there's a small risk, so you have to be willing to lose that money. But as you get sophisticated with using this, you can use these multiplier strategies, and you can also use it not to lose money, but you can multiply your gains. But you can multiply your gains to a certain limit. So let's say if you have a time horizon of 1 month and you are owning a stock, and if the stock moves in the direction you're thinking, you might make, let's say, 100 on it. If you use options without losing a penny or a dime, you can make 200 out of it. But let's say if there's a big move in the stock, and you will lose that additional big move. Let's So if the stock had moved only that 100 which you were anticipating, you can make, instead of 100, you can make 500. But if the stock moves, let's say, 500, then you will only make that. Let's say the stock moves 1000. Okay, that's a hypothetical case. The stock moves 1000, but you will only make 500 plus the 100 on the move. So you will make your income will be capped to 600, not the 1000 move that the stock made. But look at the flip side. If the stock only moved that 100, you are making 600 instead of that 100 on the stock move. So you can use this as a multiplier strategy. You can use it to acquire stock at a cheaper rate. So I will show you how that works also. So if you're buying stocks in option in the lot sizes, then you can use it. But if you're acquiring stock in small quantity, then you cannot use option strategies. But if you're acquiring stock in large quantities, you can use options to acquire it at cheaper rates. You can use it during events, and events I did cover earlier, but I'll show you which strategies you can use during events using VIX to your advantage. Okay, many times the VIX goes crazy, and you can use it to your advantage to make additional income. You can you can have spreads. There are vertical spreads, there are iron condors, different types of strategies that you can use to generate income. There is a slight risk you have to consider. So, and there's a law of averages, or there's a rule of probabilities that you have to consider while using spreads if you're doing it repeatedly. uh, there are multi-leg option strategies which we will also cover in our next session. And then, of course, we'll look at since we will look at VIX, we will also look at how time decay works, and which strategy should you use for buying and which ones should you use for selling, and when should you use leaps. I know leaps is not very popular in India. It is in the US. So US does have an advantage of using leaps, because you can buy long range options for leaps and use it to your benefit. Okay, I think that's all I had for now. Do leave me your feedback, send me your feedback so that I can tailor my content more. And if you're interested to look at advanced strategies as well as the basic stock market investments for young students, for your children, subscribe to our YouTube channel. I will cover all of this in our subsequent sessions. And do join us on Telegram. The link will also be in our bio. So if you would want to get live updates, do join us on Telegram also. All right, thank you for listening. And if there's any questions, I can still take it up. We do have about 8 9 minutes remaining, so I'm happy to take up any questions. I'll wait for 2 minutes. Otherwise, we can end this stream. Thank you, everyone. I'll stay on for a minute or two if you have any questions. Otherwise, I will drop off and end the stream. Okay, I will end the stream. Thank you. Bye bye.